Welcome back to The Explainer. Today, we're diving into literally the most powerful force in personal finance. You've probably heard the terms compound interest and dividends tossed around, right? But honestly, very few people actually grasp how they work under the hood. So we're going to break this down using real, concrete numbers. The goal here is completely demystifying wealth creation for you. No jargon, no Wall Street buzzwords, just showing you exactly how everyday folks build extraordinary financial security. Now, what if I told you the most powerful tool for building wealth requires absolutely zero financial expertise? I know, it sounds exactly like one of those cheesy late-night infomercials. But here's the thing, it's actually the foundational truth of investing. Most of us, we aren't taught financial literacy in school. We're kind of led to believe that to get rich, you've got to be a math genius or some Wall Street insider or have this super complex trading algorithm. But as we're about to see, that couldn't be further from the truth. Actually, I absolutely love this quote from our source material. It says, "The reason compounding deserves its legendary reputation is not that the math is clever. It is that the math is violent." Okay, let's unpack that for a second. When they say violent, they mean it in the best possible way. Given enough time, compounding doesn't just quietly add to your wealth. It multiplies it. It multiplies it in a way that completely defies our normal human intuition. So you don't need to be clever, you literally just need to get out of the way and let the math do the heavy lifting.
Section 1, the engine of compounding.
So, to really wrap our heads around this, let's look at the basic engine of compounding. Imagine a purely hypothetical scenario. You take a single deposit of $10,000. You invest it today in a broad U.S. equity index fund, and, this is the crucial part, you leave it completely untouched. We're going to assume it earns a 7% annual return, which is roughly the historical long-run real return after inflation. You don't add another dime, you withdraw nothing, you just add time. Look at how this curve builds. The crazy thing here is that human intuition is naturally linear, right? We expect money to grow in a straight, steady line. But compounding is exponential. After 10 years, your 10 grand is nearly 20,000. 20 years? Almost 39,000. By your 30, you're looking at over $76,000. It starts off like a slow trickle, but then it just dramatically accelerates. And then, just look at this final number. A staggering $149,745. Just think about that for a second. You did not add a single extra dollar after that first deposit. That first decade, it only produced about $9,700 in growth. But that final decade, between year 30 and 40, that 10-year stretch produced roughly $73,000 all on its own. That right there is the absolute signature of compounding. It's incredibly slow at the start and just mind-boggling at the end. Moving on to Section 2, the power of monthly habits. Okay, so that last scenario is great for clarity, but let's be real. It's pretty rare. Most ordinary people don't just have 10 grand sitting around idle waiting to be invested. We build wealth the exact same way we earn our paychecks, incrementally. So let's pivot. Let's look at how the frequency of your investments totally changes the game. We'll compare two investors, both aiming to invest $6,000 a year over 30 years, assuming that same 7% return. Investor A is super diligent. They deposit a lump sum of $6,000 once a year every January. Investor B goes a different route. They just automate a $500 deposit every single month. At the end of 30 years, Investor A has roughly $567,000, but Investor B, they're sitting on $590,000. Guys, that is a $23,000 gap. And I think this brilliantly illustrates the completely effortless advantage of frequency. Investor B didn't invest a single penny more than Investor A. They literally just put their money to work earlier in the year. Instead of that cash sitting idle in a checking account doing nothing, it went to work in February, March, April. Plus, and this is a huge psychological bonus, automating a monthly habit completely removes the emotional temptation to time the market. You're just letting the calendar make the decisions for you. Section 3, the dividend reinvestment machine.
Up until now, we've kind of treated returns as just one single number. But stock market returns actually come in two distinct flavors. You've got the price of the stock going up, and you've got dividends. Now, dividends are basically cash payments that companies hand out to their shareholders from their profits. Most people, they treat dividends as just a nice little bonus. But as you're going to see, they are actually the secret fuel for long-term wealth. I want to introduce you to one of the absolute best acronyms in personal finance, DRIP. It stands for Dividend Reinvestment Plan. I know it sounds super complicated, but it's usually just checking a tiny box on your brokerage website. When you turn in a DRIP, instead of the company depositing cash into your account, that cash is automatically used to buy more shares of that exact same company. And guess what? Those new shares then generate their own dividends the next quarter, which buy even more shares. It is the ultimate self-reinforcing cycle. Let's look at the hard math on this. Imagine a $50,000 investment over 30 years. Let's say the fund has a 5% price appreciation and a 2% dividend yield. If you just pocket those dividends and spend them, treat yourself, your portfolio grows to about $216,000, which, hey, isn't bad. But what if you check that drip box and automatically reinvested those dividends? Your portfolio explodes to $376,000. You literally added a staggering $160,000 to your final wealth just by putting those cash distributions right back to work.
Section 4. Time beats amount every time. All right, so we've seen the mechanics, but now we're getting to the emotional climax of this explainer. This is the one scenario that personal finance educators always come back to, and for good reason. It brilliantly proves why starting early is absolutely 100% non-negotiable. I want to introduce you to three people: Clara, Marcus, and Diana. All three of them earn that 7% return, and all three invest exactly $5,000 a year. Here's the difference. Clara starts at age 22, invests for just 10 years, and then stops completely. Her total amount invested? $50,000. Now Marcus starts late. He starts at 32, but he invests every single year for 30 straight years until he's 62. His total invested is $150,000. Finally, Diana. She starts at 22 and never stops, investing continuously all the way to 62. Total invested? $200,000. Look at these results at age 62. They are unbelievable. Clara actually beats Marcus by $130,000. She invested literally a third of the money Marcus did, but because her money had 10 extra years baking in the compounding machine, she absolutely crushes him. And Diana? Well, Diana just kept going, and she's a millionaire. So here is the absolute crucial takeaway. The first 10 years are worth more than the next 30. Honestly, it's brutal math. A 25-year-old who waits until 35 to start investing doesn't just lose 10 years of growth. No, they forfeit 50 years of compounding on the dollars they really should have invested during that first decade. Now, hey, if you're already past your 20s, please do not panic. The compounding machine isn't closed to you by any means. It just means you need a bit more input to get the same output. Take a look at our late starter here. If you start at age 40 and you invest $12,000 a year for 25 years, you still end up with nearly $759,000. Yes, of course, the early starter ends up with over $2.5 million. That gap is massive, no denying it. But $750,000? That is a highly meaningful, life-changing retirement cushion, and it's built purely through discipline. Starting late is far, far better than never starting at all. Section 5. The Silent Wealth Killers. All right, we do need to shift gears for just a second. We've talked all about how compounding builds your wealth, but we definitely need to warn you about the forces that compound against you. Because compounding, it's not a one-way street. Meet the silent wealth killers: inflation and fees. These two use the exact same exponential math we've been praising this whole time, but they use it to destroy your money. Inflation exponentially erodes your purchasing power over time. Think about it. At a 3% inflation rate, your dollar literally buys half as much in 24 years. This is exactly why you have to invest just to tread water. And fees? Man, these are a silent tax. A management fee of 1% doesn't just reduce your total return by 1%. It takes 1% every single year, relentlessly chipping away at the very base your money is trying to compound on. Let me show you just how painful that 1% fee really is. If you have a $200,000 portfolio over 30 years, the difference between a high-fee actively managed fund charging 1% and a low-cost index fund charging 0.05% is nearly $290,000. That's almost $300,000. That is the actual real-world cost of a supposedly small fee. That is your money just vanishing into thin air, all because you didn't pay attention to the expense ratios. Section 6. 4 simple rules to win. Okay, we've covered a lot. We've gone through the violent math, the habits, the dividends, the timing, and of course, those silent killers. So let's distill everything we've unpacked today into 4 highly actionable, totally jargon-free rules. These are your simple rules to win the wealth game. Number 1, start as early as humanly possible because those early dollars compound the longest. Number 2, contribute regularly. Set up automated monthly transfers so your cash never just sits there idle. Number 3, check that drip box and reinvest your dividends automatically. Let that cycle spin. And number 4, protect your hard-earned money from the silent killers by sticking to low-cost index funds to minimize fees. None of this requires a finance degree, guys. You don't need to hire a fancy stockbroker. It really just requires consistent, automated action. The arithmetic simply does not lie. And that compounding machine, it is always running in the background. Your money is waiting. So the only question left is, when will you put it to work? Thank you so much for joining me for this explainer. I really hope this gave you the clarity and the confidence to take control of your financial future starting today. See you next time.